Thanks for joining us, Simon. Really appreciate it. Thanks for taking time.
Pleasure.
Big name, AXA. Everybody knows about AXA Investment Management. Love to get an introduction of what are you guys up to in Asia?
A lot, frankly. AXA Investment Managers is the major asset management arm of the AXA Group, and over the course of the last number of years, shall we say 4 to 5 years, we have taken a very strong view about Asia. I was originally in London, then they transferred me, some would say banished me, here at the end of 2012. And I arrived with virtually 3 people and the company chicken. And of course, we're now at 80 people, but sadly we've lost the chicken. The aspiration for us really is to use this region as a great opportunity for the investment management arm. And we see some fantastic opportunities, but with that, in the context of change and digital and what's happening there, we see a lot of challenges. But the good point about it is I think Asia's at the front and centre of a lot of what's going on in the whole technological world, which makes it fantastically exciting.
Excellent. So how many people, what's the scale of the business or anything?
So we have 3 joint ventures, in addition to AXA in Hong Kong, in Singapore, Australia, Japan. We have 3 joint ventures, one in China, which is an outrageously successful joint venture, one in India with the Bank of India, and one in Korea with Kyoba Life, an insurance company.
Right.
It was an interesting statistic last year. AXA Investment Managers took in net new money, I think it was about 58 billion.
Wow.
Of which 36 billion came from Asia.
Fantastic.
So, it's bearing fantastic fruit, and it's vindicating our views about the true general.
Yeah, I mean, we heard a lot about cash flows and where money's going, and I've got to ask you this question. It's the elephant in the room. Active versus passive, where things are going. You clearly, AXA's raised a lot of capital last year and inflows. How much of that went to passive? Is passive an issue for you guys? What are your thoughts on that?
So we see ourselves very much as an active manager, and we're comfortable in that position. Big questions invariably result in incomplete answers. It's a very, very big topic. It's a topic that is not an either-or topic. I think people need to understand that. We obviously pride ourselves on our ability to generate alpha. Obviously, the passive industry has evolved substantially since the GFC, where a lot of people became very disenfranchised and, shall we say, frustrated with some of the advice. Fees are now a big issue, but I think at the end of the day, there's a number of aspects that people need to bear in mind with the passive. Obviously, the big cap issue and the weightings in trending markets are a big risk, and so ultimately you find yourself heavily weighted to markets in ways that you often don't anticipate. So that's the first thing. Benchmarks of themselves are notoriously challenging because one often doesn't understand what's actually in a benchmark. So a benchmark in the US, shall we say, efficient and liquid may be vastly different than a benchmark in Asia. So one needs to bear in mind the fact that you don't always have plain vanilla benchmarks. If you're looking to invest in Korea, for example, 20% in one stock, is that a sensible investment choice? It just depends on what you want to do. So it's loaded with a lot of risk in that sense. The other point about it is you are to a certain extent slave to who wants to put what in the index.
Right.
And so that in itself, people just need to understand. So I'm not saying one's better than the other. I think you need to look at it in the context of your objectives and what the clients need. I think the other big point about all of this is that we look at it from a solutions perspective as well, and a lot of our clients sort of look at it in terms of how do we blend the different parts of bonds, equities, alternatives, and that often doesn't necessarily just come with investing in an index. A very dear colleague of ours uses the analogy of blending Cabernet and Merlot, and you can do things in different ways, but it just depends on what you want to do and how you want to achieve it.
So clearly, it seems like the passive boom is a solution to fees. And as an active manager, there are other areas we should be focusing on, which kind of blend itself quite well into your skill sets and what you guys do with the quant funds. Again, moving away from the pure passives into risk-neutral strategies and stuff around that. I'd love to hear about what AXA's thinking is there.
So coming on to that active-passive piece, one area that we think is quite a sensible way of looking at things, accommodating in many respects the quant piece, is the smart beta world.
Right.
So the smart beta world is all about essentially stripping out all the mega caps and then transferring or devolving that investment into, shall we say, the small and mid-cap, the belly of the curve, and then looking at other factors in addition to that. And we think that's a pretty sensible way of investing. We've got a lot of interest in Australia. We're starting to generate a lot of interest here in Asia more and more. Certainly in Europe, we've won some very, very substantial mandates. So if you take that piece, but secondly, we have the benefit of two things. We're just launching expertise in Hong Kong, which is very data-driven, very quant-focused, called Chorus, which is an absolute return liquid strategy, global strategy, which relies upon a lot of the data that, of course, you got. Right, that's the plug.
Thankfully, all of the data that Thomson Reuters provides them, which I have to have a plug-in for that, clearly.
There's a sponsor. But that's a fantastic new thing. We just launched that a month ago, so we've got a very, very big element of hope and aspiration in that. But secondly, we've been in the quant space with AXA Rosenberg, our quantitative arm, for the better part of 30 years. Bar Rosenberg initially launched this many, many years ago. He started Barra. So we think that the quantitative process can in fact generate a lot of good, sensible return, accommodating a lot of the challenges that data and big data in particular is now putting forward in a sensible way. And the Rosenberg team, based out of Arinda in San Francisco, have a whole wealth of very, very smart guys who look at this but do it in a very, very sensible way. So, you know, we think that they're best placed to look at this stuff very seriously.
You touched on an interesting topic there about data science and big data and what's happening there. Now, as you know, at Thomson Reuters, we spend a lot of time and energy trying to get into that, and we're doing a lot of interesting things in that space. Love to hear your perspectives on big data and what's AXA IM doing in that?
It's an enormous area of focus for us. We look at it from a number of factors. We look at it obviously from the front office, the analytics piece, making sure that the investors ultimately have the right investment decisions in their portfolios. And that's something that we're starting to look at from the perspective of, you know, acquisition of data, how we acquire it, how we use it. That's the first point. Secondly, obviously, we look at it from the distribution perspective and how, shall we say, we can get access to a lot of the client requirements, needs. And again, we're looking at different parts from that perspective. And finally, obviously, the cost efficiency piece is another big area of focus. So we're looking at it centrally. We're talking to a lot of people such as yourselves. We're making sure that we talk to the right people. It's a big topic. You've got to have good governance around it. The difficulty, I think, is understanding the application and being able to, in a sense, use that. I think a lot of this stuff is very much in its infancy. But certainly the stuff that we're looking at the moment, we're comfortable with. Satellite imagery, you know, some of the other stuff we think maybe is a little bit early, but we're building it in a sensible, controlled way. So it's a big area topic. I think the key with all of this stuff is making sure that you understand what you're using. There's obviously a lot of noise out there. There's a lot of data that we touched upon. I think, Sanjeev, you touched upon before, just the sheer size of data that's been developed, and the key is making sure that you distinguish the noise from the indicator and what creates a genuine signal, and that's something that we spend a lot of time at looking at.
So is this a alpha generating tool or a cost saving tool, and how do you guys think about this when you look at big data?
Probably a combination of all those. Again, I think the front office analytic piece is very, very important from an alpha generation perspective. A lot of the stuff that we're doing on the client side is driven by getting access to the data to generate, shall we say, the business aspect. But on the operational piece and the efficiency, it's around cost as well, and speed to market and sheerly simplicity, which is very important.
Great. Now, I'd like to change tracks here slightly. There's another topic that comes up constantly when we talk to asset managers and asset owners, and this has to do with ESG. We know that AXA IM is a pretty big ESG player. I'd love to hear your thoughts on where is AXA? What are your thoughts on that?
Sure. So we started looking at ESG, or responsible investing, many, many years ago, and I think we go back to 2001 where we started looking at hiring a responsible investment team, originally based in France and the UK. We've now got a team of just under 20. It's a very, very large area of focus for us. We have a genuine belief that it adds value. We have a genuine belief that it adds value but also allows us to be socially responsible investors. What we're not trying to do is to drive a social or political agenda. We are first and foremost investors, so we have to accommodate the interests of the the investor, and in particular, obviously, the performance. So that's a very, very important point to look at. We see a number of themes that are coming out, and we are now at a stage where we've got in the order of about 406 billion or 408 billion of our assets under management integrated with the ESG factors. And that of itself creates a great opportunity for us, because we look at the market and people look at us and say, okay, we understand what you're doing and we totally get it, but they have a lot of confidence that we can do it. The problem with all this stuff, it's very young. I think it's really only in the last 10 years that a lot of the data that we're looking at now has really started to evolve. So again, you've got that question of making sure that the data and what information you're getting becomes measurable and can be used in a way that generates alpha, rather than just the noise.
So that's interesting. So if I'm hearing you right, what you're saying is it's not so much a screening tool.
No.
You're using it as a factor for portfolio construction itself.
Right.
I'd be curious, I mean, what are some of the challenges you're seeing with the ESG space? Are you seeing consistent data? Are the requests that you're getting from your clients the same? How do you manage with all of that?
So the measuring aspect is very, very important. People have got to see the impact, especially around the impact investing area. They've got to see, shall we say, the correlation or the impact of the money going into a particular topic, and that's always very, very difficult. I think the cleansing and the quality of your data is absolutely fundamental, and obviously you guys are doing a lot around this space, and so that's an important area, but you've got to understand the data. So it's all about measuring the data, understanding the data, and understanding the trends that are coming from it. Obviously, a lot of people at the moment are a little bit concerned about whether or not it generates alpha or whether or not it's something that they can measure, but we go beyond that, and we see it from the perspective of mitigation of risk. And it's not just the alpha piece, and that's an important part. So in the bond space, as an example, we look at avoiding the blow-up. So we look at a lot of these factors that we overlay onto a lot of our investment processes as being another opportunity to ensure that we avoid the blow-ups. Whereas obviously on the equity space, we look at the more, shall we say, the growth aspects and the contribution to that piece. But there's a very, very large wind of change that's happening in this world, and I think more and more, we're looking at the millennials, we're looking at some of these other areas of, evolution. I think we touched upon there's something in the order of 400 millennials in India at the moment. There's a massive change in social conscience happening. And more and more people are looking to invest the way they are living. And that's something that's becoming more and more obvious to us.
No, that's a good point. I think research has showed that by the year 2020, about 2/3 of the assets are going to be managed by millennials and women, which clearly has a knock-on effect in terms of the kind of assets you're managing, some of the profiles of, that you're trying to do. Is there anything else you could add with this new demographic change?
It's staggering. The millennial piece, I read something, it was something like 59 trillion are going to be inherited by millennials in 2060. There's a very big education piece happening here. If you look at it from the perspective of this whole generation who have to generate a whole bunch of savings to ultimately retire on, 1% out of a bond return is something that they're probably not going to be too happy with. So, there's a piece here where we see an opportunity of partnering with a lot of these investors and having to respond to that challenge, because it's now sort of just beginning. So unlike the post-retirement market where you get a whole bunch of savings and then you've got to make sure it, shall we say, lasts for the balance of the retirement, now they're at the accumulation phase. And so we need to be in a position to at least assist them in that regard.
Interesting point. You touched on another interesting theme here as an active manager. Clearly some of your millennials and the new investors coming in are not looking for single asset class investments. So most of your portfolios now, is it fair to say it's multi-asset class, and you guys look at beyond a single asset class itself in terms of the offerings and the funds?
Yeah, so bonds and equities, combination. Obviously there's an interesting potential for green bonds. We're seeing more and more of that as something that people are looking to get involved in. But we've sort of got to do it from a balanced perspective. Each of the discussions we're having has to be based around what the objectives and the aspirations of the individual clients are. And it's not just a case of pushing, as I said, a social or political agenda. We're looking at stuff, for example, in Australia, we're looking at potentially launching a women's fund, which is looking at gender diversity and which is looking at, education for young women at school, which, both very, very big topics. We're not looking to invest in monies. We're not looking to invest monies in companies to have the token female, shall we say, in a particular function. We're looking at companies that are looking at genuinely at creating diversity and opportunity. And there's a big opportunity, we feel, in that area. You know, it's silly to neglect 50%, shall we say, of a population just by virtue of the fact that, you know, you've got such few, you know, at board level. Somebody told me in the ASX 300, something in the order of 6 women sat on, boards had 6 women sitting on it. So there's a lot of examples of this, but we're looking at very, very seriously, bearing in mind the key principle of making sure that we make money for clients.
Clearly. Now, as if these challenges were not big enough, you're now faced with another wave of technology and innovation happening with digitization. What are you thinking? How does AXA deal with that?
Carefully, absolutely carefully. It's very hard because the car's in motion and we're all being asked to change the wheels and change the colour of the car and make, you know, the whole nature of the landscape is changing quite rapidly. I think the key with all this stuff is creating an innovative mindset, and I don't know if Deborah touched upon it before, but an innovative mindset rather than an adaptive mindset. And that's triggering a lot of sensitivities within companies. Because you've got to look at things very differently.
Can I interrupt you there? I'd like, for the audience, how would you differentiate the two, innovative and adaptive in terms of mindsets? It's quite subtle, the difference there, but I'm sure it takes a different approach to each one of these.
Well, I think you've got to look at the nature of the individuals. I think, you know, these guys we just hired in Hong Kong, a fantastic example where they just think outside the box. They look at, and the way they deal with data, and they look at things very, very differently because that's the nature of their business. That's what they do, and they know they have to be, you know, thought-provoking and they have to think ahead. What we try and do is we try and encourage innovation through things like you know, innovation teams. We use the AXA lab, shall we say. We've got 3 AXA laboratories, one in Shanghai, one in Singapore, one in San Francisco, to generate ideas, to bring in thoughts, all that sort of thought leadership, talking to you guys, talking to people who know what's going on. And it's about sort of getting outside the box. And we like to think we're doing that. So to a certain extent, we're trying to generate that within the firm itself. A lot of firms, for example, are looking at the way they set up premises, the way they build their offices, looking at temperatures, light settings, water, power, all this to generate innovative environments. And I know Sandy Carl from Citi, I think she did a fantastic job on this recently, talking about all these what appear to be strange things, but are actually quite important to generate that piece.
So before we wrap up, it's been 3 years in Asia now, or has it been
4.5?
4 years? How's it all worked out?
It's very good. It's an exciting place. It's, you know, the thing, and somebody said to me when I came over, he said, the thing in Asia, people are looking to grow wealth, not retain it. And, you know, you look at a lot of the innovation that's happening in Asia. We do, in Asia, have the benefit of looking at what's happening in the West, and in the case of the regulatory side, cherry-picking a lot of what we're doing. But also, you've got a lot of, you know, fantastic young generation people who are coming with fantastic ideas and new concepts, and just the demographics and the sheer size of Asia is just so very, very exciting.
All great, exciting stuff. Clearly, there are things that keep you awake at night. What part of your business do you think you're most challenged on?
I'm not going to give you the business line. I think it's keeping pace with the people. I think we need to make sure that if we're going to use all this technology, we've got the right people in the place. Because you can have the most fantastic instruments, but I think with all these firms and all our business opportunities, we need to look after the people to make sure that they can keep pace with what's happening. And I think if we don't do that, then we're running an opportunity very, very short.
Thanks a lot, Sam. Really appreciate your time. I think we're running out of time here, but ladies and gentlemen, please give him a warm hand. Thank you very much. Appreciate that.